We actually significantly revised down our China's growth rate from 5.6% to 4.8%, or almost 0.8% percentage point from our October forecast, mainly because of the several factors, but the consumption slowdown due to the outbreak of Omicrons, and then also the financial stress in the real estate sector. So, and then also important global factor is a slowdown of the US economy. But the question is whether the China can achieve 4.8% growth rate or even higher really depends on the two things. One is the dynamics of Omicron and the future dynamics of this pandemic, which is very hard to forecast. But at the same time, the government willingness to use more policy spaces. For example, like last year, they really tightened their fiscal policy. And then in our forecast of 4.8%, we still assume that China will continue a fiscal contraction, even though it's milder than last year. So, but if the growth rate goes down, I think they have a room to use more fiscal resources. So depending on how much they will use fiscal resources, China growth rate will be determined. But we have a dilemma of the deleveraging versus maintaining the growth momentum at this moment.
Changyong, how vulnerable is this region to the Fed's tightening cycle, especially the deficit countries like India and Indonesia?
We have good news and bad news. Good news is that if you compare with the taper tantrum period, the external factors such as the current account surplus and the level of the foreign reserves are much higher at this moment in Asian countries. On the other hand, overall, the debt has increased quite significantly after the global financial crisis. In around 2007, Asia accounted for about 27% of the global debt. But now in the 2021, Asia's account for almost 40% of global debt. So higher interest rate, even though they may not cause a big shock to the financial market, but they can definitely slow down Asia's recovery and growth.